Okay, hello everyone. In this video, I'm going to cover a few skipped slides from the chapter 15 PowerPoint slide from page 24 through page 30, covering international bonds and bond covenants. So let me share the PowerPoint slide. Okay, well, in terms of the places where bonds can be placed, bonds can be both placed domestically and also internationally. So the domestic bonds are the most common type of bond issuances. So domestic bonds are bonds issued by a local entity denominated in the local currency and traded in the local market. For example, if a US company issues a dollar denominated bond in the US market, that is a domestic bond. But bonds does not necessarily always placed domestically, but they can be placed internationally. And there are three different types of international bonds that can be issued. First type is what is called foreign bonds. And foreign bonds are issued by a foreign company, but denominated in the local currency and trades in the local market. For example, if a US company goes to any foreign market, for example, Japanese market, and issues Japanese yen denominated bond, that is foreign bond. Another example, if a non-US company, for example, Japanese company comes to US market and raises a dollar-denominated bond, that is also foreign bond. So to help your understanding, let me show you this chart. Okay, so in terms of the international bond, the nationality of issuer and market and currency matters. So for the domestic bond, all three nationalities, issuer and market and currency, are all local. The US company raising dollar bond in the, for example, sorry, in the dollar bond in the US market, that's domestic. But if any foreign company comes to a local market and raises a local currency denominated bond, that is foreign bond. Okay. But what's funny thing about the foreign bond is there are many different kinds of foreign bonds, and they get to receive very funny nicknames depending on the nationality of the marketplace. So for example, let's consider the following examples. So for example, if any non-US company comes to the US market and raises dollar-denominated bond, that is called Yankee bond. So the characteristic of the US, that is Yankee. The nickname for the US, that's Yankee. In another example, on the other hand, if any non-Japanese company comes to the Japanese market and raises Japanese yen denominated bond, that is samurai bond. So the rule to attach the nicknames for the foreign bonds, that is, the nicknames go by the nationality of the market, not the issuer. The nicknames of the foreign bonds go by the nationality of the marketplace, not the issuer. So if the US company raises Japanese yen denominated bond in the Japanese market, that is samurai. If a Japanese company raises dollar denominated bond in the US market, that's Yankee. Okay, then let's go back to our previous slide. Okay. Okay, so we have considered Yankee bond and samurai bond, and there are many other examples of foreign bonds as well. For example, what do you think that bulldog bonds will be? Okay, the bulldog bonds are British pound denominated bonds issued by a non-British company and issued in the UK market. That's bulldog bond. How about the Austrian dollar denominated bonds issued by the non-Australian company placed in the Austrian market? what would be the nickname for the Australia? Yes, that's the kangaroo bond. Okay, so that particular kind of foreign bond is called kangaroo bond. Okay, so once again, the rule to attach the nickname for the foreign bonds is to the nickname matches the nationality of the marketplace, not the nationality of the issuer. The second kind of international bond that can be issued, that is Eurobonds. Okay, Eurobonds are international bonds that are not denominated in the local currency of the country in which they are issued. So the key distinction for the Eurobond is, as you can see from this chart, the key distinction for the Eurobond is the mismatch of the marketplace and the currency. Okay, so once again, the key distinction for the Eurobond is that the nationality of the market and currency does not match. The nationality of the issuer can be any in case of the Eurobond. Okay. And back to our slide. Okay. So the Eurobonds, they're not subject to any particular country's regulations. So it's very flexible kind of bond issuance. And Eurobonds can be sold and traded internationally. Okay? Well, third kind of international bond is called global bonds. And global bonds are bonds that are offered for sale in several different markets simultaneously. The global bonds combine the features of domestic, foreign, and Eurobonds, and the most flexible kind of international bond. But the key distinction for the global bond is that it can be placed in multiple different markets simultaneously. So that is the key word to detect the global bonds. And unlike Eurobonds, global bonds can be offered for sale in the same currency as the country of issuance. Okay. Now, let's turn our eyes to this one last problem related to the debt issuance, which is called agency problem. Okay, so what is the agency problem? So when the firm issues debt, especially when in financial distress, firms' incentives are distorted and the interests of shareholders and managers and bondholders may be in conflict. Remember that to begin with, due to the different nature of debt contracting and equity contracting, equity holders are supposed to be more risk-taking and risk-loving than debt holders. Remember that debt holders, they have fixed claims in the firm's assets. They get the promises in terms of the amount of interest and the principal. No matter how good the firm does, the payment to debt holders does not increase. On the other hand, equity investors, shareholders, they do not receive any guarantees or promises in terms of their claims. Rather, they are betting on the upside potential of the company. Therefore, when the firm is doing bad, shareholders don't lose anything because they were not guaranteed anything to begin with. But if the firm does well and the project turned out to be a jackpot, then shareholders are taking all those upside potentials. So to begin with, shareholders are supposed to be more risk-loving and risk-taking than debt holders. This conflict of interest could be more distorted and intensified when the firm is near bankruptcy or financial distress. In those difficult times, remember that when the default happens and bankruptcy happens, remember that debt holders can take over the company, and in most cases, nothing will be left for the equity investors. Therefore, when the firm is near or at bankruptcy or default, the shareholders' distorted incentives could be really intensified, and they may even pursue very selfish strategies at creditors' expenses. So let's consider the following example. Suppose a firm has outstanding debt amount of $1 million, which is maturing in year one, let's say time T1, okay? And standing at time 0 right now, the shareholders, the insiders of the firm, they know that the firm is in trouble. the only asset within the firm is cash balance of $10 million, and that's it. And insiders, shareholders of the company at time zero, they know that the company is doomed to die at time one. Okay, but knowing that, what can they do? What is the most evil strategy that shareholders can do at time zero? Well, remember that until the default actually happens, debt holders cannot have any voting power or any decision making within the company. Before default happens, it's all shareholders' decision, right? So at time zero, the most evil strategy that shareholders can do at the debt holders' expenses is to declare one-time big special dividend. So without restrictions, the firm shareholders will have incentive to pursue wealth transferring strategy at time zero. So they can declare the entire cash balance of $10 million as special dividend at time zero and leave empty shell to debt holders. So when time one happens and actual default happens, and when the debt holders eventually take over the company, they will only find themselves left with empty shell, right? So this is very selfish strategies that shareholders can pursue at creditors' expenses. Then how creditors, debt holders can prevent such selfish wealth transferring behaviors? The answer is covenants. Okay, the covenants are restrictive clauses in a bond contract that limit the issuer from taking actions that may undercut its ability to repay the bonds. Okay, so covenants can be included in the bond indenture or bond contract to prevent a possible wealth transferring or selfish behaviors by shareholders and insiders or managers. Okay, so covenants protect debt holders from wealth transferring behaviors by managers and equity holders. And if the firm fails to live up to any covenant, which we call technical default, then debt holders can have the same right as they have in the time of payment default. Okay, so remember that when the payment default happens, debt holders can take over the company and become new owner of the company. With the inclusion of the covenants, when the firm fails to live up to any covenant, which is technical default, then even before the actual payment default happens, the debt holders can take over the company and take the company into bankruptcy court. Okay, so the inclusion of the covenant gives really strong protection for the debt holders. Okay, there are two different kinds of covenants that can be included in the bond contract. One is negative covenants, the other is positive covenants. So negative covenants, they prevent the firms from taking certain actions. Positive covenants require the firm to take certain actions or require the firm to meet certain standards. For example, negative covenants can include clauses like preventing a special dividend amount, or debt holders can prevent the company from selling more senior debt, because selling more senior debt will dilute the debt holders' priority and seniority in the event of default. And debt holders also can include provisions that prevents certain balance sheet item or ratios going over an agreed upon limit. For example, the leverage ratio cannot go beyond a certain level. Okay? Positive covenants are requiring the firm or the shareholders to undertake certain actions. For example, debt holders can require the firm to use proceeds from sales of assets to buy other assets rather than paying dividend. Okay? Or debt holders can require the firm to provide audited financial information. Okay? So there can be any kinds of covenants, and any type of covenants can be included in the bond contract as long as the two parties can be agreeing upon. Okay? So the blue box is showing the examples of typical covenants. You can take a look when you have time or when you are interested. Okay, lastly, is it a good thing or a bad thing to have many covenants? So what would be the advantages or disadvantages of having covenants? At first glance, you may expect that equity holders would try to include as few covenants as possible in a bond agreement, because with more covenant, the freedom or flexibility of shareholders will be limited. Well, on the other hand, the stronger the covenants, the less likely the firm will default on the bond. Therefore, with a smaller default possibility to begin with, the debt holders may agree on the lower interest rate to begin with to buy the bond. Okay, so the reduction in the firm's borrowing cost can be more than outweighing the cost of the loss of flexibility associated with the covenants. So at the end of the day, there exists a trade-off between the flexibility and lower cost of borrowing. So few covenants is not necessarily always better than many more covenants. There's a trade-off between more covenant and fewer covenant. When you have fewer covenant, the insiders, shareholders will have more flexibility, but that will increases the possibility of selfish strategies. Therefore, it will increase the cost of borrowing and vice versa. When there are more covenants, the flexibility will be limited, but with a smaller default possibility and smaller possibility of selfish strategies, debt holders will be agreeing on the lower cost of borrowing. Okay, so at the end of the day, there is a trade-off between the many covenants and smaller number of covenants. Okay, so that is the end of this chapter, and that concludes our learning about the debt issuance.